Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Joe Palmer. Thanks for being on the show, Joe.
Thank you very much, Whitney. Thank you for having me.
No, I'm honored to have you on the show. Somebody with your level of experience. I'm looking forward to the conversation. But since 2009, Joe has raised over $44 million in capital to purchase, develop, lease, and sell real estate. Since 1999, he has invested millions of his own money into the very same deals he syndicates and is usually one of the largest investors in his own deals, even going so far as to personally guarantee every loan in every deal. Joe, thank you again for your time and just your sharing your expertise with the listeners and myself. Give them and me a little more about your background, and let's dive into the syndication business.
Yeah, absolutely. I think, Whitney, like most of us, I think most of us real estate investors, I think the way we get started, we often might have invested in the stock market prior, or other things, bonds. Maybe we're more conservative, and we find our way to real estate because of promise of better returns. I found it the same way. I had a corporate career that I retired when this business got to grow substantially. But when we also, as happens with most of us, we join in one particular area. So I started in multifamily investing, and I did just a couple of passive deals, and I quickly became a lead investor and then a syndicator. And you do what often most of us do, and that is you have some success and you parlay your returns back into the same thing, more multifamily. And that's smart and that's wise because you're leveraging your learnings, you're leveraging your network that you've developed. So it's a smart thing to do. However, as time goes by and you keep doing that, a couple of things happen. Number one, the market is changing around you, and you're slowly starting to notice. Maybe you're not getting the same returns you used to, and you're starting to realize why as this market has changed around you. Additionally, you start to realize you've got a large amount of your personal wealth wrapped up into one thing. And if that one, if cap rates go up on you, or something happens, something can happen geopolitical or economic, it could really hurt you. So I found myself in that position. I had launched Concilium Capital Group. I started off doing my own deals, then family and friends, and then syndicating widely. And the group on the whole had noticed this, and we had noticed, apartment returns weren't what they used to be. And we noticed something that within our group, we had some serious experts in other areas of real estate. So our little network had some broader capabilities. And we started inquiring and looking and following some of these other capabilities in other areas of real estate and finding that some of those were trending up and they were becoming very attractive. So this led us to do other types of real estate investing. And then we continued to do the same. We continued to watch the market, watch the economy, and basically go to what the market was giving us. And thus, over the years, we've done a little bit of everything. We've done residential, commercial, single-family, multifamily. We've done development, construction, lot development, and most recently, mortgage notes.
Wow. So, it's interesting, you came from a corporate background, got into real estate, and you I like how you talk about you had everything invested and you start to realize, okay, if something happens here, we need to think through this a little bit. Right. And you talk about how the market is changing around you. If you're not careful, like all of a sudden things have changed a lot and you haven't maybe been paying as much attention as maybe you thought you were, but you all have been paying attention and you started to notice that you have experts on your team that are people that are experts in other areas of real estate.
Absolutely. Right? And the funny thing is we all get so laser focused on that one thing that we know well, we know the best, and that has treated us well over the years. We get laser focused on that. So often in this industry and all of us real estate investors, we don't lift our heads up and look a little bit longer term, right? And I think I was very lucky by the people I had put around me. and the fact that we had these other talents and skills. And that's really served us well, and it's made us kind of unique as a capital group and as a syndicator. I'm kind of known now around the industry for that, for the fact that I have the ability to do so many different things. So I find a lot of people come to me and they're very involved and very deeply invested in other things, but they come to me specifically for basically diversification. So what I often say, kind of my Concilium Capital Group tagline is that we syndicate diversification. So we may not always be with a lot of our investors. They don't have their majority of their equity and their capital with me, but they bring pieces to me where they're wanting to diversify and get, in many cases, something that's maybe a little bit lower risk, lower return, a little bit steadier. So that's one of the major things we provide that most others don't.
No, that's awesome. I think it's a great quality. And tell me about your team and just the team of experts that you're talking about.
Absolutely. So obviously we started, as I say, I started off mainly for myself. I wanted better returns in the stock market. I thought real estate was the way to get good, solid, better returns at a reasonable risk level, and it absolutely has been that. But as time wore on, and it expanded to family and friends, and then to a broader investment community. Early on, you're mostly interested in, people come to you, you chat, you get to know people, and you're doing deals together. But as we started kind of noticing that the market was changing on us and we wanted to do other things, we started to all talk collectively together, often on team calls, and often it'd be on a particular deals call, but we'd wrap up that deal and we'd chat for another 20 minutes. And you just start to learn that, this person you've known for a year or two is a lawyer in a real estate firm, right? And you start to talk to them about what they do and what they have done in the past and what they're doing now. And that conversation sparks another one and someone else chimes in. Now these were often passive or limited partner type folks, but as you start to chat about what can we do as a group next and how can we leverage that ability, people are very willing to step up and participate and contribute their expertise and their networks and their contacts as well as their money. It's kind of like all you had to do was ask, right? So yeah, we've got lawyers and accountants and real estate professionals of every walk of life, agents and brokers, and just property managers and whatnot across the board in every aspect of real estate. And all we had to do was ask, and all we had to do was leverage it.
Yeah, I mean, you can't be an expert in every part of this business, can you? I mean, you have to surround yourself with experts. It's
a team sport, as is often said, right?
So you had mentioned a few minutes ago, like you went to what the market was giving you, or things were changing and you're willing to change with it, I think, and keep your head up like you were talking about. Can you elaborate on just how the market changes and then, how you all really changed as well because of that?
Absolutely. As I said, we started in multifamily, kind of the classic Class C, right? Buy and rehab, fill it up, and then your mortgage comes due, or your note comes due, and you look at your exit opportunities. And obviously, cash flowing was always our goal. But as cap rates were plummeting, we got tremendous value out of these things, and we sold off all of those. And knowing that we weren't, we were going to be very, very happy to sell in this low cap rate market, but not to buy in it. So that was one of the first times when we realized where would we put that money if we sold? And what we found within the collective group was construction, that the market was really rewarding developers for constructing new things. So we quickly leveraged those capabilities and started building. We've built over a dozen condos in the Bishop Arts District of downtown Dallas. We've built over 100 single-family lots up in Sanger, Texas, 1-acre estate homes in Argyle, Texas. So we jumped into construction, and the timing was good for that. But this was 3 or 4 years ago, and we see that changing around us as we're doing it. Going forward, we're not so much interested in starting new construction projects. Probably still some raw land deals, but less construction. And our research has now taken us to mortgage notes, since 2007, and then Dodd-Frank, which came up in the aftermath of that. As you know, the banks have just walked away from subprime lending altogether, pretty much. Dodd-Frank kind of forces them that way. But luckily, the private sector has stepped up, and the private sector is providing these notes, and they're providing a really good return to really qualified people with good jobs, moving into really quality assets. And right now, we're finding that to be a very attractive investment, where we can get 8 and 9%, sometimes even 10. We're in the first position lien. These are 80% LTV. They just cash flow so steady, and they're for the return, they're relatively low risk.
Nice. So, and I'm grateful, like, as you went through that, you were talking about some different signs and things that were happening. Anything else, like, or maybe even signs that you see happening right now, just from your experience, things that you see happening now and how the market's changing?
Yeah, we're still, my group is still focused largely on Texas. Now we're doing some notes outside of Texas. Assets are assets and notes are notes, and most of the markets we're doing them in are very solid and stable. But so we focus mostly on the economics of Texas. One of the most recent reports that came out that was talking very much about the job growth, specifically the Dallas area has had, but all of Texas for sure, in the past 10 years, and it outlined it with all kinds of statistics, but it went on to forecast that they see the same growth for the next 10 years. I think, a lot of people thought the job growth would be slowing sooner than that. This was a very respected group of economists putting this out. But that doesn't mean that that all of these growth factors within the real estate industry can continue indefinitely, right? Just like the roads are struggling to support this influx. But it doesn't mean that there will be people continuing to move to Texas. Let's take cap rates. Can they go lower? Possibly, but not much, right? These are historically low cap rates. Of course, we have a lot of money flooding in from California, especially 1031 money, New York as well. The money's coming here because of that growth. But even those investors, there is a bottom limit to what they'll accept for their money, even with 1031. So we certainly don't see cap rates going much lower, but with this jobs report for the next 10 years, we do see them as being fairly stable.
So do you plan, or let's say cap rates go back up, or, the market takes a big change, you plan to go back to multifamily or development at some time, or, or is it, or, this is kind of your plan to wait, until there's a better time to get back into multifamily?
That is a very insightful question. And that's so much so that was the conversation I just had today with the team. And the team is very interested. And I think this report spurred the interest on that. One of the reasons we kind of got out of apartments was because of fear of cap rates going up, right? Now, this thing says that they're probably not going down, but it does say they're probably pretty safe and stable. So a lot of my group, having come from multifamily apartment investing, is now very much getting reinterested in it. If they think we can get in and out a couple of times and still relatively safely without the fear of rising cap rates. So absolutely, we do think we'll be heading back that direction.
Nice. So what's your, just from your great your level of experience and the listener that's getting started in this industry, that's wanting to be an operator, maybe they're having some of the same thoughts that you've talked about, maybe I'm not sure if this is the right time to get into multifamily. Maybe I should think about notes, or maybe it is, I just wonder, could you give them some guidance?
Absolutely. I think the advice I would give, and it's something I wish I'd have picked up on sooner, is that thing we talked about earlier, which is lift your head up once in a while and look around the industry, look around the market, read the economics, the forecasts, everything that's going on. But absolutely learn one aspect, be successful with it, parlay that, reinvest, but also lift your head up once in a while and look around. And sometimes there's some really cool stuff going on around you, some really profitable stuff going on around you, that if you don't lift your nose off the grindstone once in a while, you won't even notice that. Mm-hmm. And that's where I think we've become like I said, around the industry, we've been sought out for consulting gigs. We've been sought out for mentoring. And I think the reason is that it's that message. It's when you lift your nose off the grindstone and look around the industry, what are you seeing? And then, of course, in my team's case, they come to us and say, well, can you help us? Can you help us get involved with that? Can you help us put an investment together to go after this, right?
Okay, so here's the simple truth. If you don't have private investors waiting on the sidelines right now, you're going to have a hard time closing your next syndication. Are you afraid to talk to investors? Do you feel you have a lack of credibility, or no one will take you seriously? Or what about your systems? Do you have anything set up yet? Well, if you know you can improve on getting in front of and influencing passive investors, then you should call my friend Adam Adams. Adam has a proven system for you to flip the script. Now, this is a 5-figure investment for you to take your business to the next level. I want to see you succeed, so I placed a link in the show notes for you to apply to work with the Adam Adams. And if you think you qualify and you know you're going to take action on what he teaches you, then scroll down, find the link, and take your money-raising abilities to the next level. What's some of or maybe a really good resource to help us to monitor the market, or maybe something you use or something you read every day, something that we could also educate ourselves on the market with?
Yeah. So funny thing is, I'm a fan of Motley Fool, strangely enough, but they have a pretty broad base of resources out at their website, and they do talk a lot of real estate at times and investment. So I visit that one a lot. Again, I think partly it's entertaining, and it's kind of fun to do, but also you do pick up and learn some things on there. Of course, if you just, like I said, right now, the mortgage notes attract us. If you just Google investing in mortgage notes, there's some wonderful resources out there. And of course, our website is investccg.com. I'm still mostly email based. So, excuse me, when you go to the website, you'll find kind of small snippets of what we're involved with, what we're doing, and what we're raising capital for now, which happens to be the mortgage notes. You can click on that. You'll get some photos and some info, but then it'll lead to, if you're interested in more, click here, send an email and saying I'm interested in more. And then, of course, we can inundate your inbox with all kinds of resources and information.
Nice. So, Joe, what's been the hardest part of this syndication journey for you?
So, I can answer that question, and it also semi-answers your previous question about someone who's starting up. I found for sure it was the beginning, getting started, doing your first deal. There's a lot of fear that comes with doing your first deal, and my first deal involved a $2 million note I had to sign, so there was an enormous amount of fear. Luckily, I had a mentor who got me over that fear, and I signed that note, and it was fantastically successful, right? So I think the fear factor, and then just pulling the trigger and doing your first deal. And I think every investor will tell you the second deal you'll do is hugely more easy than that first deal was.
Yes. So, how are you, and I know we've talked about this a little bit, but I always ask, how are you prepared for this potential downturn that everybody's talking about?
Yeah. So, right away, we're real estate investors, and being real estate investors, we're already, and I tell this a lot to the people I coach and mentor, you're already inherently within real estate. You're partly protected against certain things, inflation, you're going to be very protected against. And no matter what happens economically, even if the jobs slow down in Texas, you still own real estate. The word real means something. That is not going to evaporate on you, right? But what can happen is your ability to exit, your ability to monetize these things can change quickly on you, right? Where something's very, very sellable today, and 6 months from now, it could take you a year to sell it, to move it at the price you want. So what we mainly do is make sure we're never too heavy in one thing. So back to the diversifying thing, we make sure we're always somewhat balanced. And an exercise we like to do is, if we needed X amount of dollars next week, where would we go to get it? And if we went there to get it, what would the return be like if we had to liquidate that, right? And we do that at least once a quarter. to be sure that we're well balanced. And well balanced is one thing a lot of real estate investors are not, and that is the one thing that Consilium Capital Group brings to the industry.
Nice. Nice. So yeah, I love the diversification and just thinking through that and kind of being flexible with and watching the market.
Absolutely. And being ready that, diversifying and being a little bit safer, being able to have liquid cash available to you if a downturn happens when you need it. It might mean taking a lower return than you're used to, but you must remember that also comes with a much lower risk. So sometimes, all your money in high risk, high return things can eventually burn you. So we're big at preaching that as well.
Do you ever get, people that say, well, Joe, I really feel like I'm better off focusing on this one thing, like multifamily or whatever they're in, self-storage, so I just learned that and I know that really well, no matter what the market's doing, as opposed to, switching asset classes.
Yeah, I get that a lot. In fact, when I got started, I was a huge, and still am, a huge Kiyosaki fan. And of course, in his most famous book of all, in the first book, Rich Dad, Poor Dad, he clearly lays out that, that there's big benefits to be had from being an expert in something and putting all your eggs in one basket, right? I don't know if he said it that way, but he does make the case that leverage your strengths and go with it and make a bet on yourself. And I'm all for that as well. But there comes a point where a little bit of common sense comes into that equation as well. And in some of his other books, he does talk about that. He does delve deeper and talk about, diversification. I don't know if that's the word he uses, but it's basically the same principle that all your eggs in one basket can grow the quickest and the best by leveraging your strengths, weaknesses, resources, network, but it can also burn you just as fast if a combination of events happen when you're not expecting it. So,
sure. So, Joe, what's a way that you've recently improved your business that we could apply to ours?
I would say most certainly it's these mortgage notes that we're investing in now. And again, it's an 8% return. And it's funny that new investors, new real estate investors will hear 8% return and turn their nose up at it, right? Like 8%, that's so low. I'm not in this for 8%. But it's the older, more sophisticated, more experienced investors, their eyes light up when they hear, when you say 8%, what do you mean? I say 8% APR on the note every month. Every month your account gets dinged, ding, 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 with these monthly payments at an 8% return. And sophisticated investors recognize the value of that and what that means to their overall portfolio. And that has been a revelation for our group. And not only is my kind of previous experienced investors eating it up, but I've got new people flocking in for this stuff.
Nice. So, I like to ask as well. And other than the 8% every month, what's a way that you stand out in your relationship with your investors?
I think the number one biggest thing that's different about my group as well is we're basically entirely transparent. And by entirely, let me tell you how far I mean by entirely transparent. Every investor, when they invest their money, as you know, in most cases in real estate syndication, you'll launch an LLC for that one investment. That LLC will have a bank account. All of my investors actually have a login to the bank account.
Wow. Anytime
they want. It's utterly full transparency. And I don't think I've ever heard of anyone else who does that.
We've done almost 500 shows and I've never heard of that. So that's incredible. That is some transparency right there.
It is. It adds a little bit of workload, but it's absolutely unique, and our investors love it. I hear it from a lot of them that they've also never seen anyone else do it before.
So, what's the way you're finding investors right now?
So, until recently, we really weren't looking very hard. Basically because we basically had our plates full, and just in terms of pure ability to take down new projects and manage them properly. But now we've had, just in the past several months, we've had a few of them conclude, and final distributions. And it just was good timing when we started to really see the value of these notes and gain experience with them. So right now it's been mostly word of mouth. We've had some consulting gigs that have worked out well for us for marketing, getting exposure to new investors, and then just our website and LinkedIn and that type of thing. So we haven't done a broad marketing push to attract new, but I think now with this note thing doing so well and getting so much interest, I think we're about to relook at how we do go out and do a little bit of more of a broad-based marketing approach to get attention for that and get some interest in the door for those mortgage notes.
What's the number one thing that's contributed to your success?
I would say my faith. Certainly, like I said, that initial fear comes into play, but then also you're partnering with people, and being able to partner with people, you want to trust those people you're partnering with. You need them to trust you. You're all going to go do something together, and definitely kind of having that a Christian base and being able to feel comfortable and safe that no matter what you do, it's in bigger hands than yours, right? So and of course, every time we were talking earlier on the show about economics and the potential of shifts in market and all that kind of stuff, it's all out of your control. And even these experts you're reading, these expert economists that you're reading, it's out of their control. No one knows. They can't predict the future. So having a good solid foundation for those things is really, really helpful. Let's just sleep at night.
Yes, I could not agree with you more, Joe. I'm glad it's not all in my hands, because I would mess it up. So
yeah, exactly right.
So tell us how you like to give back.
Yeah, I'm glad you asked. So within CCG, we all kind of happened to follow each other to a group called Family Legacy. They're actually out of Capel, where I live. They are a tremendous ministry whose focus is African orphans, primarily Zambia, almost entirely Zambia. And so these are AIDS orphans, and the numbers are staggering when you see the numbers. They have built and put together a network of schools in Zambia for these orphans that is amazing. In fact, anyone listening can go to familylegacy.com and just spend 20 minutes reading that website, and it's amazing what you're going to learn. So they're one of our top favorite places to give. I've been to Africa. I've spent a week with them in Zambia with the orphans. Remarkable experience, but remarkable what they've accomplished for these kids in a relatively short period of time that they've been in existence. So that's one of our favorites. We also, one of the reasons we like these notes was that back in 2007 and 2008, when it all went bad, and the banks, between Dodd-Frank and just the banks, knee-jerk reaction in general, even without Dodd-Frank, basically walking away from so many millions and millions of people who are absolutely hardworking, honest people with good jobs, families, but now since 2000, they cannot get a loan for a house. So it's kind of like the American dream evaporated on these poor people.
Right.
So, like I said, the private sector stepped in, but it's the private sector of America, and which is a capitalist country. So of course, capitalism steps in from the private sector. There's going to be an equilibrium of profit that's made on these notes. So obviously, these are subprime. These are high yield notes. So one of the things we're now doing is kind of originating and refinancing these at a lower rate. So, a lot of these notes come from real estate investors who may be single family rental people. They buy a single family home, they rehab it, then they want to sell it. What I think a lot of them are now finding is they go to sell it, and the majority of the people, of the shoppers, of the buyers for this single family home can't get a loan to buy the house. So often that team themselves will sell or finance that house to them, and then move to sell the note, right, on the open market. So one of the things we're doing is that we do a lot of just buying those notes, but we're also now starting to get word out to not the holder of the note, but the homeowners to say, we'll refi that note for you at a lower rate. And when these things work out, it's a win-win. They get a lower payment, a lower interest rate, and we get a very good very good borrower, and it's still a good return on a good asset. So it's kind of a win-win, and it certainly improves the situation for them, and still gives us a nice, solid, steady paying return on a good investment.
Wow. Well, I appreciate your time, Joe. You've been a great guest, and I like how you talked about your team and team of experts and how you've been able to keep your head up, watch the market, and also know how to change to different asset classes depending on what the market's doing, and kind of be flexible in that way. And then also how you give all your investors access to the bank account. I think that's very interesting. I'm gonna look into that, and because I've not heard of that before out of as many people, operators that's been on here. But that's definitely a way to be more transparent and to stand out, and appreciate you sharing that and the way you give back and about your faith as well. But tell the listeners how they can get in touch with you and learn more about you.
Absolutely. So obviously, I think the probably number one way is on the web, investccg.com. So that's invest, CCG as in Concilium Capital Group.com. Like I say, it's not an elaborate website. It'll give you a little bit of a taste. Then click one of the links and send me an email. I read every one of those emails, and tell me what you're interested in. And we are still small enough that it's very boutique, and there's not one of our investors I don't know. I haven't at least spoke to at least a few to several times. So that's the best way. I'm also on LinkedIn. I'm not a huge, I don't spend a lot of time on LinkedIn, but I'm out there and I get the messages. So that's another good way to reach me.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.